The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The best day of the week for U.S. stocks as the S&P claws its way back to 6,000. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Alex Steele. We're kicking you off to the closing bell here in the U.S. Guess what?
What?
Good news is good news for stocks.
I love it.
Right? Who would have thought that? All right, here we go. Looking at the market here. The S&P holding on to the rally we've seen pretty much all day, sitting at 6,000. If we close at this level, we will now officially be in a bull market. Everything else seems to then make sense. You got selling in the front end of the bond market as the data came in pretty strong, and then you have a stronger dollar and you have a stronger oil as well. So buy the cyclicality and sell the safety, Romaine.
Absolutely. And we talk about that 6,000. Remember, the last time we were here was back in November. The last time the S&P closed first time, I should say, it closed at 6,000 in history, on its way to that cycle peak of 61.44 and change in February. But of course, we had the sell-off in March and April. But that, at least for right now, seems to be firmly in the rearview mirror. While the S&P still needs to rally about 2% or more to get back to its all-time high, the MSCI All-World Index reclaimed that record on Wednesday, and it is on pace to set a new one today. Investors emboldened by economic data that for now suggests no material drag from that trade war. Speaking of which, the monthly payrolls report was part of that sigh of relief. While it did show U.S. job growth moderating in May and prior months, data was revised lower. This was not the wheels fall off the truck kind of labor report. So you cue the equity bulls, they have the reins. You cue the bond bears, and Treasury prices drop, yields higher, retracing all of last week's drop. And now swaps traders who had been betting on 2 Fed cuts this year, trimming expectations, but just a tad. Of course, for the president of the United States, that's not enough. The president taking to social media to demand a full percentage point cut in the Fed funds rate. Rick Reeder, CIO of Global Fixed Income at BlackRock, says he's still betting on just 2 rate cuts this year, which sets up, in his words, an even more dovish glide path for 2026.
I still think they would like to get a couple of cuts done this year. And you got to see that deterioration in some of the labor conditions to see that. But I think they'd still like to get a couple done.
Which brings into question how much more juice is left in the rally. So this shows that white line is the S&P and the blue line are the S&P members that are above their 200-day moving average. Currently, we're only looking at 48%. I bring that up because if you don't have full participation within the market and you're only being led by, say, 48% of those stocks, is that enough to continue to grind your way higher? And is it enough to make new highs? Now, Romaine, JP Morgan sees an imminent upside squeeze because institutional investors are now chasing that market higher. But again, is that going to be enough to broaden the rally?
Well, Katie Nixon joins us right now to maybe answer that question. She's Chief Investment Officer of Wealth Management at Northern Trust, helping us kick you off to the close here on this Friday afternoon. And Katie, when you look at that big rally that we have, impressive to be sure, there are a lot of questions about the lack of breadth to a certain degree in that rally. And really going forward, the idea that a lot of the risk that led to this sell-off to begin with back in March and early April, those risks haven't necessarily been removed, or have they?
They haven't, Romaine, but I do think the tail risk of a very bad outcome on the trade front has been removed. Again, negotiations are underway. We're going to see progress over the next several weeks, and I think that's really helped the market bounce significantly off that bottom. And it's hard to believe that we were in a 20% correction and now we have a 20% rally in such a short period of time. But you're right, the risks haven't completely just disappeared, but they've certainly dissipated.
And we should point out, of course, we have been reporting that negotiators from both China and the U.S. are scheduled to meet on June 9th in London. So progress, and I think that progress on the trade front has been a big catalyst for some of the gains that we've had. As we move forward, though, Katie, we still have unresolved issues with regard to the economic impact of what's already happened. We have unresolved issues, obviously, with regard to that budget bill in Washington. Can you still be bullish with those laces still untied?
So I think you can be constructive. I wouldn't necessarily say bullish. A lot of good news has been rebaked into the market, I guess I would say. And we do anticipate that we'll have some volatility over the summer, Romaine. We've got a lot of work to do on the trade front. We have geopolitical issues that are popping up left and right. And we also have earnings that are slowing down, actually. We're seeing analyst estimates come down as we get into the back half of the year. So we can be constructive on equities, but we can also acknowledge the fact that it might be a scenic route to the end of the year and not a straight line up like we've seen in the last couple of weeks.
It's easy to get caught up in the tactical trading headlines that come out from the White House, but some of that could have structural changes. Budget deficit, for example, the importance of U.S. dollar in global trade, in that do we pare back some U.S. exceptionalism? And that's a structural change. What are you advising clients?
Well, we're not really buying into that structural change and the end of U.S. exceptionalism. We think some of the other areas of the world, though, are sort of catching up. It doesn't mean that the U.S. is not still exceptional, but it means that there's also very good opportunities overseas. And that hasn't been the case in the last several years. So we're reminding our clients of the importance to be a global investor. Alex, it's like, when Romaine asked a few moments ago about, being bullish on U.S. stocks, I said we're constructive on U.S. stocks. We're actually pretty bullish on non-U.S. stocks, and in Europe in particular, seeing that dual tailwinds of monetary policy, fiscal policy, and then adding into that the low expectations. The groundwork has really been set for a little bit of catch up there, we think.
If the ECB, though, is done with their rate cutting cycle, does that remove one of those pillars?
Potentially, but we don't think they're done. We have in our forecast one more rate cut this year for the ECB as inflation continues to trend down. And as some of the pro-growth initiatives that are obvious in the fiscal stimulus around infrastructure spending and defense spending in Germany in particular, just take a little bit of time to work their way through the system. So we see a downside to the growth forecast as well as the inflation forecast that will support one more rate cut for the ECB.
Interesting. And when we bring this back to the U.S., Katie, and the idea of sort of the individual stocks that investors have gravitated to, we've seen sort of a push back into some of those large cap names, obviously NVIDIA, obviously Microsoft, and a few others, not necessarily just for the growth story. There are a lot of people looking at these names as being a little bit more defensive because of the cash generation and because of the perception that they can ride out any storm that might be ahead.
It's been really interesting, Romaine, to see sort of the different themes as they've evolved over this trading year. We had sort of the market broadening out. We had the equal weighted S&P trumping the cap weighted S&P pretty significantly coming into the last several weeks. And then, as you note, we have the resurgence of sort of these big tech stocks. And frankly, investors are going where the growth is. These stocks continue to outperform from an earnings perspective. And I think you're right, and you're spot on to recognize that these are cash flow machines, and they are actually defensive in a market that looks to be, continuing to be a little bit uncertain, and an economic backdrop that also continues to be a little bit uncertain. So investors are flocking for a number of reasons back to those previous winners. And you are seeing that, as you referenced in the chart earlier, in a narrowing of market leadership.
And just finally here, I am curious just about the business spending side of what's going on out there. We focus a lot on consumer spending, but we know certainly for financial markets, a big part of this trade has been one driven by CapEx, specifically CapEx in the space of AI and the associated technologies. Do you have confidence that that CapEx spend will hold up?
We really do, Romaine. And it's not just AI CapEx, but we see a CapEx renaissance taking place really under some of the provisions in the tax bill that's working its way through the Senate right now, with the depreciation in particular making capital spending very, very attractive. We see AI in particular, but more broadly, CapEx supporting, not just supporting the economy, but certainly supporting the market as well.
Katie Nixon, Chief Investment Officer of Wealth Management over at Northern Trust, kicking us off to the close here on this Friday afternoon. A big jobs report this morning and a big conversation up ahead. Betsey Stevenson, Professor of Economics and Public Policy at the University of Michigan, joins us in just a second. This is The Close on Bloomberg.
President Trump weighing in on this morning's job report on Truth Social, first posting shortly after saying, quote, America's hot. 6 months ago, it was cold as ice, borders closed, prices down, wages up. And then later he said, too late at the Fed is a disaster. Europe has had 10 rate cuts. We've had none. That's not actually true. And despite him, our country is doing great. Go for a full point rocket fuel. Here with her insight is Betsey Stevenson, a professor of economics and public policy with the University of Michigan. So I guess first, rate what you think this job number was. Was it a B, B plus, B minus?
Well, first, I'm just still laughing at that claim that the Fed should cut a full point. What we saw was a jobs report that, I think I would say, here I'll tell you, as a student, I would give it a B plus, but I would actually understand that they know less than that B plus reflects. And that's what's going on with this jobs report. It's a B plus, maybe even A minus jobs report, but then you look underneath it and you see some weakness that means there might be problems further down the road.
Right, so that brings us to that, pushing on the Fed to cut rates 100 basis points. Okay, that seems very extreme, but is it an economy that needs rocket fuel if you do see cracks under the surface?
I do not. I just don't think it's an economy that is necessarily going to be helped by rocket fuel. One of the things that's happening, and this is what we're seeing in a broad range of reports, is there are a lot of companies that are taking a wait and see approach as they're trying to figure out how this tariff uncertainty is going to resolve. That's slowing everything down a little bit. And, changing rates isn't going to change the uncertainty. There's still going to be a lot of value from waiting. And the biggest concern I have is that we've got a lot of inflationary pressure coming from the tariffs and the reduction in trade that is related to the tariffs. And so there's, whenever supply contracts a little bit, if demand doesn't contract a little bit too, you're going to get inflationary pressure. So, I think the Fed has to balance both the inflationary pressure and a weakening jobs report. And right now we have a jobs report that shows a little weakness underneath it, but we also saw wages coming in faster, showing that maybe there's more inflationary pressure. And so if you've got those two directions going and you're the Fed, the right choice is continue to wait and see.
I am curious, Betsey, about just the complexion of the report when you kind of break it down, particularly when it comes to geography as well as demographics of the population, because there did seem to be some pretty interesting disparities. And I'm wondering if some of those disparities actually slows down the potential for Fed action.
Well, the kinds of there's two types of disparities. We can look at the report from employers, and what it's showing us is the diffusion index is down, meaning that almost all of the job growth occurred in just two places: leisure and hospitality, and business and professional leisure and hospitality, and education and employment, private sector education and employment. And we actually saw declines in business and professional services. And so that makes me nervous when we've just got two sectors, particularly one that's very seasonal, leisure and hospitality, that is driving basically all of the growth. That worries me. Now, there's the second thing you were talking about, demographic groups. That's the household survey. Mm-hmm. This household survey was a disaster. Mm-hmm. It showed the number of employed people falling by 700,000, nearly 700,000. If you've got that kind of big decline in employment, we just got to hope that that's a bunch of measurement error, because obviously it doesn't match what's happening in the employer survey. But that makes me really reluctant to dive too much into these demographic differences, because this was a household survey that showed us that across the board, households were less likely to have jobs, less likely to be in the labor force.
I do have to ask you a question, and it's a little bit loaded, and it is also about just the reliability of data. There's been a lot of discussions about some of the changes in Washington, particularly when it comes to the agencies that collect this data and put it out. And let's just say the drop in headcount that we've seen at some of those agencies. Do you have enough confidence that as we get these reports over the next few months and quarters, that what we get out of the jobs report, the CPI, et cetera, that the collection of the data and the dissemination of those final numbers are going to be a true reflection of what's going on out there?
You're right. It's a loaded question. And I'm going to tell you that during the first Trump administration, I believed adamantly that there was absolutely no way our data could get polluted. I'm now more worried about it just because of the headcount reductions make it harder for people to stand up and say, wait a minute, something's going weird with our data. But I still think it's a pretty impossible task for somebody to meddle with the data. Mm-hmm. But that's not the concern you're talking about. One is just do they have the resources they need to collect the data accurately? And it's clear that they are losing those resources and that they're not able to do as good of a job. But that doesn't bias the data in a particular way. That's not going to show us slower inflation or faster inflation necessarily. It's just going to show us noisier measures of inflation, which means we have less information from any single report, which means that if you're the Fed, you may have to gather data from other sources or wait longer before you make decisions because you're not really sure what's going on because the data is getting noisier. And that's certainly what people were concerned about with the recent CPI. They had to impute a lot of data because they simply didn't have the resources to check it.
All right, Betsey, great stuff. Always wonderful to talk to you. Betsey Stevenson, professor of economics over at the University of Michigan. And just a reminder, the next big data point, at least from the government, that comes next Wednesday when we get the consumer price index. Of course, we are talking a lot about that big rebound in the S&P, 20% off of its lows. And, well, some individual stocks have really helped to drive that. And that includes Visa, now up about 21% since that low back in April. We're going to talk to Dan Dolev over at Mizuho about why he decided to upgrade his recommendation on that stock. That's coming up next. And on the close, this is Bloomberg. All right, let's get right to our top calls. Big movers on the back of analyst recommendations. And we start off with Deere. Milius upgrading the ag equipment company to buy, boosting the price target to a street high, $750. The analyst cites Deere's leading position in the ag tech space and sees investors starting to price in recurring revenue value over the next couple of years. Those shares having a pretty good day, up about 2%. Second straight day of gains, first weekly gain in 3. Next up, McDonald's. Loop Capital downgrading to hold, trimming the price target to $315 from $346. The firm has some growing concerns that Mickey D's domestic comp growth profile won't rebound as much as expected. They also added that poorly received chicken strips launch does not bode well for the pending snack wrap introduction. Those shares sliding for a 5th straight day and 3rd straight week. And finally, Lululemon, a number of firms souring on the athleisure retailer, including Citi, which lowered its price target to $270 from $325. It did maintain the neutral rating. But Lululemon's first quarter results, in the words of that analyst, were disappointing. They add that the tariffs and investments are weighing on margins as the company looks ahead to the next quarter. Those shares right now down 20% for their worst decline since March of 2020. All right, those are some of our top calls. Let's take a look at a stock that's moving in the opposite direction. Shares of Visa up for yet another day. Mizuho upgraded the stock just yesterday to outperform and boosted the price target to $425. The analysts there are saying Visa's cash-to-card runway, quote, still has legs, leaving room for another decade of solid top-line growth in the U.S. Pleased to say Dan Dolev, the analyst behind that call, joins us right now, senior analyst over at Mizuho. Dan, great to see you.
Thank you.
When we talk about the runway for Visa, what is driving that? Is it people are swiping their cards more, fees are going up? What's the mix?
So we thought up until now, and I can explain to you what happened, we thought that basically everyone's using credit cards in the U.S., credit and debit cards. And because of that, there's no more opportunity for them to outgrow personal consumption and expenditure, which is PCE. And so what we found out, basically, there was a mismatch in categories that made that penetration number look artificially too high. And that was the revelation of the note.
So what does that mean, though? Like in layman's terms, when we talk about what the growth story looks like, what is that growth story specifically?
So that's a great question. Yeah. About 2/3 of their growth, not too many people know that, so I'm not naming anyone specifically, but 2/3 of their volume growth historically is just cash to card conversion. So in year 0, you're using X% of your spend on card. In year 1, it's X plus something. That delta gives them extra growth.
I got you.
Okay. So how does that compare with other card users?
With other networks, you mean, with other networks. It's the same thing. The reason we had a neutral on Visa, now we have a buy, is that they're outsized exposure to the U.S., to debit, and the U.S. is sort of like, ground zero of what we thought was the end of the runway. And now that we think that the runway is actually longer, we feel more comfortable upgrading it. So MasterCard, to your question, it has more exposure to Europe, so it's less exposed to the U.S., less exposed to debit.
Oh, interesting. How do we feel then about the consumer in relation to all of this? Like, it's always that world when, like, all of a sudden the credit gets a bad credit versus a good credit. I never know when that is.
So the consumer right now is fine.
Okay.
You got me thinking about chicken strips now, but the consumer is fine.
Yeah.
It's actually we've not seen any data right now that shows that the consumer. There was a little bit of a hiatus in April, but things snap back because remember we cover Square, Cash App. We look at Affirm, Buy Now Pay Later.
So you see exactly.
Fine.
You see exactly what's going on. You see the transactions, right? So people are still transacting.
Yeah.
They're transacting at levels, and you think those levels will sustain themselves.
Yeah, I mean, restaurants are full. We're not seeing any slowdown there. Toast is doing great. So as of now, today, I don't know what's going to happen tomorrow, but today, things are great.
When we talk about this idea, though, of the spend, and also the whole idea of cash to card conversion, and we know that finance, just generally how we pay and how we transact for things, is changing a lot. We may all be using stable coins, well, one day if Circle and Tether have their way about it. But it gets to this idea as to whether Visa is prepared for whatever the next phase of this fintech revolution is, whether they actually have the ability to capitalize on that, or is this going to be a situation where we're going to bring you on a couple years from now, you're going to be talking about some smaller company that's eating Visa's lunch?
So we were thinking about that too, but the key thing here is remember that it's like that commercial from Capital One, what's in your wallet?
Yeah.
So as long as you go to the store and you pull out your debit card or your credit card, Visa is going to be just fine. So the consumer adoption. So you're not going to show up at a restaurant and say, "Hey, can I pay with this stable coin?"
Yeah.
They're going to be like,
"Well, maybe one day,
someday, not yet."
Yeah.
This stable coin, we like stable coins, but those are, the Circle business model is kind of weird.
But we don't have to get into
talk about it next time. But the stable coins, as is, are good for cross-border transaction. There's really no use case intra-US for you to pay with stablecoin versus. But to your point, right now the network is really powerful, and they're getting into more and more verticals in the network.
So I think we were talking about this yesterday with the Circle CEO. Is that why can't we use traditional banking and deposit stuff for stablecoins, like for the internet system? Like, why do we need something totally separate? Is there a world where that could ever happen?
So why do we need, why can't we use a stablecoin instead of the traditional banking system?
Flip it. Like, why can't we choose traditional banking and make it a stablecoin?
I agree.
Oh, okay.
I think I'm still struggling to understand, I'm scratching my head, struggling to understand the big attractive business model within Circle. I don't cover it, but it seems a little bit maybe overhyped right now.
All right. Thanks so much, Dan. Really appreciate it. Thanks for coming in. Dan Dolev, a managing director and senior analyst over at Mizuho, breaking down the consumer, doing relatively okay.
Yeah, that seems to be the narrative for the last couple of weeks, right? Everything is okay.
Yeah.
Right?
But
are you fine with that, Alex?
No, fine is the worst word. Okay is a terrible word. But we're seeing, QSR companies doing a lot better, right? You're seeing higher income people go eat at QSR restaurants, for example. What does that tell us? Like, you're buying more durable goods, like you're hunkering down. That's a different kind of feel. All right, well, coming up, we're going to speak to Rashad Bilal and Troy Millings, the CEOs and co-founders of Earn Your Leisure. This is Bloomberg.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Boston.
And I'm Alex Seal, taking a look at an S&P that's holding on to its gains, where it looks like we could be closing into a bull market at this point.
Yeah, and you go back to that big drawdown that we had, really started in late February into March and April. That big drawdown, $7 trillion in valuation wiped off. But this big rebound we have come up, you know who's driven that, Alex?
Tell me.
Retail investors.
Yeah, which is amazing. And you know what's done well? Seagate, Micron, NRG, GE Vernova. It's still somewhat very tech specific or tech adjacent. And you have to wonder again what that winds up meaning for the broader economy and the broader market.
Absolutely. And when we talk about the power behind this market and who's driving it, the idea that individual investors really have become a much more powerful force. That's not just opinion. It shows up in the data. And of course, keeping a closer eye on what's going on in that space is critical for everyone involved. Rashad Bilal and Troy Millings, they're the CEOs and co-founders of a company called Earn Your Leisure, an educational platform that looks to help individuals obtain financial freedom and, more importantly, to build wealth. They're also the co-authors of You Deserve to Be Rich, and they host a very popular podcast. We've had you on the program before. Everyone's familiar with you at this point. I don't think we've spoken to you, though, since all of the market chaos over the past few weeks. And I do want to get your take on that, just specifically from the retail side. I mean, most of the folks, most of your followers are individual investors. I know a lot of them are invested in the stock market. They're invested in names like Tesla and Nvidia, all of these big names here. When you saw the big sell-off that we had back in March and April, what was like the first thing that people were coming to you and asking you about?
What stocks to buy? Buy the dip.
So it was buy the dip.
We spoke to the CMO of Robinhood, and he said that they had record-breaking inflows. So I think that speaks to retail investors becoming more educated now. And a lot of people looked at that as an opportunity as opposed to, some people were scared. I met some people that actually sold positions and cashed out some 401ks, but for the most part, most people saw it as an opportunity.
What do you think they were buying? Do you know?
Oh, definitely the tech stocks. When you're talking about Nvidia, when you're talking about Broadcom, when you're talking about an AMD, which pulled back, or you're talking about Micron, which you mentioned before. People believe in the AI story, and they found some discounted prices, and they've been studying it. What's interesting is that our audience has been here for a while, so they saw NASDAQ pull back in 2022. They took advantage of it then, and they saw this as another opportunity to take advantage.
Yeah, so have they just been trained to buy the dip versus, say, institutional investors that held off? I mean, JP Morgan was saying earlier that we could see some short squeeze because institutional investors have to now catch up, in essence, to retail. Are they just conditioned, and is that a risk?
I think they've been conditioned.
Yeah.
It can be a risk, but I think if you're buying good companies and you're holding them for long periods of time, then I think you minimize that risk, right? If you're buying Apple, Microsoft, Nvidia, even if it drops another 15%, if your plan is to hold it for 20 years, now I think you can fall into trouble when you start trading.
Right, so it's not really trading, it's like tactical and also structural, like all at the same time.
Yeah, but there's a lot of trade options, a lot of option traders. So that's when it gets a little bit tricky, sure.
I am curious about the run-up that we saw in crypto, particularly also off those April lows as well. And we've talked a lot on this program, too, about, you had Circle as a stablecoin issuer, just went public. eToro, which is a much more of a retail-facing site, also went public. Robinhood, which you just mentioned, potentially there's been a lot of talk that later tonight we might find out they're going to be included in the S&P 500. Is crypto, are you finding that to be a big part of people's portfolios, the people that follow you?
Yeah, I think definitely when we talk about alternative assets, maybe 10 years ago it wasn't, but there's a new generation of investors, especially in the retail space. They're watching what's happening to the dollar, they're watching the economy, and they're trying to find places where their money can grow. And crypto over the past 10, 12 years has definitely been that place, and we see that continuing, that trend.
You guys, of course, have put on some great conferences, including InvestFest, which is coming up, the big one in Atlanta this August. You've released some of the names that are going to be there. Jack Dorsey, who's, speaking of crypto, plans to be there. He's kind of kept a low profile. Magic Johnson and a few others. I am curious as to, when you sort of chart out these lineups, and Pinky Cole, who's been a big friend of the program with Slutty Vegan, what exactly are you trying to sort of get across? When you sort of collaborate, get these names, aggregate them, what is it that you're trying to put out there?
We want to diversify. So we want to get people from all walks of life. So you see Jack Dorsey, Magic Johnson, Steve Harvey, Charlemagne, 2 Chainz. It's a very eclectic group of people there, right? So
Tiffany Cross,
Tabitha
Brown. You guys, she's opinionated.
The list goes on. But Derek Hayes. So we really want to make sure that we're facilitating a conversation that all people can benefit from. So whether you're a restaurateur, whether you just started in crypto, whether you're looking to expand your real estate portfolio, we try to get a little bit of everything.
There are a lot of people that, when they looked at the drawdown, and it wasn't just the drawdown we had this year, but even over the last couple of years, about how that presents a big opportunities for kind of rank and file retail investors, and more importantly, retail investors, particularly people of color who have been left behind, an opportunity to buy into some of these high valuation names when those valuations come down. Do you think we're going to see more opportunities like that?
I think so. I think the thing we talked about for sure is uncertainty. And there's no time like this present one. And so as we go throughout the year, the summer months tend to be a slower time for trading. So we'll see some pullback. September has always been historically a month, but there'll be opportunities. But we know from a long-term perspective, if we put in positions now, the S&P or the Dow or the NASDAQ will appreciate over time. And so our community is really stern on that, and they believe in it.
So we talk a lot with wealth managers about diversifying out of the U.S., what U.S. exceptionalism changing means. You go to Europe, you go to EM, you go to Mexico, for example. What is your audience, what's your client base asking you guys about? Is it still like 100% U.S.?
Well, we've been spending a lot of time in Africa. We have a big real estate project in Ghana. We just came back from Rwanda and Kenya and Ghana like a couple days ago, actually. So there's a lot of interest of that as far as the African continent. The continent has immense resources. Obviously, everybody knows that. The youngest population, the only continent with a growing population. So I think that there's a lot of enthusiasm right now about Africa. There's a lot of success stories that's happening in Africa right now. So I think that that's something that our audience has been very enthusiastic about.
And Troy, how much risk do you feel like your audience is willing to take on with those kind of opportunities?
I think the risk is mitigated when they watch us do it in real time. I think that's kind of been our story, is people have watched us, and what they've done over the time is trusted the information that we've given, but they've trusted the steps we've done. And so we make sure that we don't go in with the mindset of thinking we know everything. We want to make sure that we connect with entrepreneurs in different spaces, people of business in different spaces, and we grow together.
We only got about a minute left. I am curious, of all the folks that you've spoken to, either on your podcast or on stage at your events, who did you find to be the most informative? The most, like, the person that you walked away?
You asked them that? That's like choosing between their children.
Yes, I don't know.
I mean, outside of Romaine?
Yeah, see, no, good. That was smart.
That's a hard question.
He was fishing for that one.
It's a hard question, but we always look to the next person. So we've had a lot of great people, but I'm really interested to have a conversation with Jack Dorsey.
Yeah.
I'm very interested to have a conversation with Magic Johnson.
Yeah.
I feel like those people who will be at InvestFest are somebody that I'm personally looking forward to. So we've had a lot of people in the past. Robert Smith comes to mind, and Steve Harvey, and Don Peebles. But we always look forward.
All right. Well, InvestFest will be in Atlanta, Georgia, once again, August 22nd through August 24th. Rashad Bilal Troy Millings, they are the CEOs and co-founders of Earn Your Leisure. Thanks to both of you guys.
Thank you for having us.
Absolutely. Coming up here, we're going to refocus on the markets and focus in on Robinhood. Riches may have earned it a spot in the S&P, and it's pushing the shares higher. It's our stock of the hour, and it's up next. This is The Close on Bloomberg. Let's take a look at our stock at the hour. It is Robinhood. The shares extending this week's gains as rumors swirl that the online brokerage could join the S&P 500. The S&P is set to rebalance or make an announcement about its rebalance. Bank of America and Barclays both say that Robinhood, a leading candidate to join the index. Joining us right now is Bloomberg reporter Matthew Griffin. All right, a lot of speculation about this. We saw, what was it, a month or two ago when Coinbase was added, and we saw the big run up in that stock. It seems like people are looking at Robinhood and saying, why not?
Yes, it's a really interesting time. I mean, first, you got to start here. What Barclays is pointing out is that they meet all of the formal criteria for entry, market cap, being based in the U.S.
Profitability, things like blah, 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 yeah.
Exactly. But yes, just last month, you have Coinbase entering the S&P 500. That's a real win for the crypto industry. That's an industry that Robinhood is closely linked to. Robinhood is one of the biggest companies that's not in the S&P 1500, the broader index. They've had a just blistering stock rally this year. They've more than doubled. So yes, there is a sort of sense of you never know for any given company, but if any stock is a really good candidate, people are starting to feel it feels like their time might be here.
If they don't get in, like, do you know who else is on the docket? Like, are analysts saying it's Robinhood or?
So a couple of the companies that I've seen mentioned, Ares in private equity, Interactive Brokers, Duolingo was on that Bank of America list. Ares in particular, Bank of America flagged that as one to watch that could see really significant passive buying if they join the index. So those are ones to keep your eye on.
AppLovin too, also being rumored about TradeWeb and Cheniere Energy at the bottom there.
There you go. Okay.
I am curious about that though, because it gets to the idea of what the S&P is supposed to represent, and it is supposed to be sort of reflective of kind of the broader universe of what's out there. So it would kind of make sense you would want to include something like Robin. I know there are already brokerages in there, but obviously Robinhood is a much different type of brokerage. Does that work in their favor maybe?
You know, it really might. There's a lot of concrete things about this company that some people on Wall Street really like. People really like the Robinhood Gold program. People like the speed at which they're able to adapt and bring new products to the market. They're making plays through mergers and acquisitions. But I think it's even less concrete than that, which is what one analyst told me is this is a company that has captured the way that a generation sees trading. Yeah. They have gamified it, they have made it interactive, they've made it fun. This is a company that really has ridden a wave, helped create a wave in modern finance. Yeah, but can it take it away? Like, if we see if there's a recession, like this has not been tested through recessionary times. COVID's different because we were cutting checks to people, right? But you go back to 2008, 2009, like could it survive that kind of turmoil? That's a really interesting point. You know, this stock trades now at about $75. You look a year out from their IPO, less than a year out, they were trading at $6, down roughly 80% from their IPO price. That came as the sort of meme stock boom faded, as crypto prices fell. You know, this is a stock that is really levered to the performance of the broader markets. Yeah. Absolutely, that's a thing that can make them volatile. Yeah. One thing, though, they're a diversified business. They have options, they have equities. You know, if there's, for example, just a crypto downturn, that helps insulate them. All right, Matthew, thanks a lot. Really appreciate it, Matthew Griffin, joining us. We'll find out. What time does it happen? Oh, well. 5? It could be after 5 p.m. Yeah, it's 5:15. So. I feel like it's usually after 5 p.m. Yeah. Right? Okay, we'll find out at 5 p.m. Yeah, stick around, Alex. So stick around. No, I'll be gone, but you can do it. All right, we're about 15 minutes away from the closing bell right here in the U.S. We're going to take you to that with Barry Bannister, Chief Equity Strategist at Stifel. What happens if we are now officially in a bull market? Now what do we do? Are we going to look at all-time highs in the S&P? Is this really Bloomberg. A bull market? It is.
10 minutes until we get to the closing bell. Romaine Bostick alongside Alex Steele with stocks up about 1% across the board. Alex Steele and everyone now talking, I'm told, what is supposed to be the start of a new bull market. Yeah, it is that. You got the NASDAQ 100 same. You got the Russell also able to bounce off of those lows that we saw on April 8th. And just individual stocks. Look, Tesla's already making a rebound too, up 3%, although yesterday was a terrible, terrible day for the company and the stock. Broadcom, although still down 5%, but not really weighing on other chip stocks necessarily. Maybe that's just a repositioning after Broadcom's earnings rather than a signal for the chip sector. Also interesting to see that one of the biggest gainers on the day across the tape is Circle. Remember that stock more than doubled just yesterday, up about 32% here on this day. You're also seeing a lot of players in the energy space, quantum computing also getting the bid as well. Maybe that's a little bit of an indication of where risk sentiment lies right now. Barry Bannister joins us right now to help us count you down to those closing bells, just 9 minutes away. He's the Chief Equity Strategist over at Stifel. And Barry, there's been a lot of talk here about this 20% rebound. It looks like we're going to close 20% higher than those lows that we saw back in early April on the S&P 500. But there's a big question right now whether we retrace some of those gains, particularly given the fact that some of the impact of the tariffs has not quite shown up in the economic data, but most economists that we speak to say at some point it will.
Yeah, if you look at the tariff revenue, it's actually starting to really come in. All the estimates I saw is about $200 billion a year. You can think of that as a tax. It's like a sales tax. We think consumers will slow down. Savings rate began to perk up. It's too low last month. The real wages, the wages after inflation, as you feed through the higher inflation in the back half, the real wage coming down will slow the consumption. You're also going to see a lull in this front running we had on pre-tariffs. So now they have to run down inventories. And capital spending. Business uncertainty is extremely high. I think they're postponing everything, and housing is still unaffordable. So a sharp slowdown in GDP is enough to give you about a 5% year-to-year pullback in the S&P 500, similar to the 3 times that happened between 2010 and 2019. Now your comps versus a year ago, that puts you in the mid-5,000.
Wow. But I am curious as to when we talk about the potential maybe for a bit of a retracement and the idea of a correction, a formal correction here. Is there a sense here that maybe that could be avoided, Barry? I know we're still in kind of the hypothetical phase of all this, but so far the data has held up. I know it's not great, but it is okay, as we were joking about earlier today.
The hard data, the actual hard data has more or less held up, except for some of the prints. The soft data has been exceptionally weak, as you know, in the surveys as well. So you could have even a convergence of those two would still imply some weakness in the hard data. Again, 2012, 2015, early 16, 2018 into early 19. Those were not recessions. There was no financial crisis, no COVID, nothing like that. And yet you still had these double-digit declines in the S&P. Usually the second decline, the pullback, is about half the magnitude of the first one. The first one was 19.5% from January to April of this year. So something like 10% off the second quarter peak that we're making is going to be it.
Barry, before we kind of get there, do we get to all-time highs again?
It's interesting. We look at the market in real and nominal terms. So there has been inflation. The real high would be somewhere in the 6,250 range. The nominal high would be 6,140 in 4 months ago. I think we may hit the nominal, but not the real. In other words, we'll fail to hit the real high. And I know that sounds like picking nits, but the fact of the matter is, when you go back in long-term market history, the real return and the real price actually are better judges for what kind of a market you're in.
So, Barry, does that mean I should be fading the rallies at this point, or not yet?
No, we fade it. We think that, as I say, the slowdown would favor things that are benefiting from a more defensive stance, not a pro-cyclical stance. You're seeing staples, beat up healthcare, waste handling companies, utilities. Those are covered by my colleague Thomas Carroll, and he likes those defensive, value-oriented names for the 10% correction that we're expecting in the late second, third, and possibly early fourth quarter. It'll be somewhere in that period of time.
I'm curious how you feel about, Barry, when we talk about, you look at the holistically a portfolio. Is there a case to be made for increasing the allocation to fixed income?
That's just it. One of the things that's very different this time, besides stock bond correlation flipping, is the fact that bond yields are actually fairly competitive with the probable 10-year forward return of the stock market. So we do a very in-depth look at that. And other big brokerages agree with us that the double-digit returns compounded for the last 10 years are extraordinarily difficult to achieve in the future. We're coming up with about 5.5% total return for the S&P 500 for the next 10 years. I can get 4.5% risk-free for 10 years from the Treasury. So my risk premium, my equity risk premium, is exceptionally low. So a lot of the damage has been done on the Treasury front in terms of driving prices down and yields up. So, yeah, I think you would balance them a little more here.
Barry, what do you think of the dollar technically? I mean, yeah, I know it's up today, but it has been a tough road. Yesterday we hit the lowest since July of 2023. How much potential downside is there technically?
Well, if you use the DXY index, which is a pretty good index, even the Chinese yuan, which is not in it, is correlated to it. So the DXY index had hit a high of just over 110, pulled back to about 99. We think over a long period, the next 10 years, it will fall to about 75. There's really tons of evidence on that. It's not necessarily a horrible thing. I mean, the index, the dollar right now on purchasing power parity is about 16% overvalued. But in the short term, if the dollar pulls back, what you typically need to see that happen is the fiscal policy has to be tight and the monetary policy has to be loose. I'm not sensing that. I don't sense that Jay Powell wants to be loose with policy in his last 10 months in office. He is protecting the independence of the Federal Reserve. And I don't think that we're going to get quite as much of a bill out of the big, beautiful bill in terms of fiscal impulse that people had hoped for, especially when you account for that tariff, which is actually a tax offsetting some of the fiscal benefits.
All right, Barry, got to leave it there. Barry Bannister, Chief Equity Strategist over at Stifel, helping us count you down to those closing bells just about 2 minutes ago. Stocks up about 1% across the board. All 11 sectors, Alex Steele, are in the green as we head towards the close on the day, on the week. you're seeing significant strength, of course, in tech and communication services. Romaine Bostic alongside Alex Steele. We bring into the program, as we do every day at this time, Scarlett Fu joins us here in the TV studio. Jess Menton from our Bloomberg Cross Asset team also joining us as well as we count you down to the closing bells. And Jess, I'll start with you. It has been a remarkable week. Alex keeps telling me we're now in a bear market.
Ooh.
Or bull market. Bull market.
Hey,
sorry.
hey,
Whoa.
I mean, we're just about 2% off of the all-time highs last reached on February 19th for the S&P 500. Now moving forward, it's what's that catalyst as the S&P hit that resistance at 6,000 to take it to that next level in the next couple of weeks here.
Well, apparently it was the jobs number, today. And I say that because if you get less bad news, do you need good news, Well,
it's another example of how the hard data continues to hold up pretty well, even though the soft data, the survey data, seems to show that people are very concerned. But the numbers, at least for now, seem to prove that the economy is holding up. By the way, I was gone for a few days. Did I miss anything? Did anyone get into an argument?
No.
It was really calm.
No.
It was nothing dramatic, nothing really big happened.
No, nothing. You missed nothing at all. And we should point out, of course, so you are referring to, of course, that spectacular drop that we saw in Tesla shares yesterday. Seen a little bit of a rebound there. I think we're going to talk a little bit more about that in just a second. But I am curious, too, Scarlett, when we talk about this idea of 6,000, of at 20% off the bottom. And as Barry Bannister is saying, he's actually predicting another correction for this market, partly because he's saying, look, we have not gotten that hard data, the reflection of the trade impact on the hard data. But he says that's coming, and then that's going to lead to a correction.
Yeah, there's still a lot of people saying that a lot of investors, particularly in the U.S., are overexposed to the U.S. They're overweight in the U.S. So if you do see more drama in the bond market, especially when it comes to trade deals or concerns about the deficit and funding, then what if that starts to spill over into the equity market? And how quickly will people move on that?
All right, well, a pretty broad-based rally here on the day with more than 400 S&P stocks in the green across the screen, basically 1% gains across the board for the day, and even more meaningful gains on a weekly basis. The Dow Jones Industrial Average settling in right around 42,758 and change, up 1% on the day, and that would be roughly about 1% higher on the week. The S&P holds 6,000, official close at the 6,000 mark, up 61 points, 1% on the day, and 1.5% or so on the week. The NASDAQ Composite up about 1% on the day, and more than 2% on a weekly basis. And the Russell 2000, that was your outperformer on the day and on the week, a 1.7% gain on the day, Scarlett, and for the week, the Russell 2000 up 3.1%.
And it's really curious because if you look at what happened in the last 10 minutes or so, the Russell 2000 soared up just in the final 10 minutes of trading, whereas all the other indexes kind of drooped into the close.
Yeah, but all still
That's
holding higher. The droop, yeah, sure, why not? We'll take it. But still, bull market for all, I think, is what we're looking at right now.
All right.
That's right.
Romaine,
show me the pie. What is this?
I was just going to go there.
Is the pie going to tell me we're in a bull market? Oh,
yes. The pie is pretty consistent. This is the IMAP, of course. It shows the 11 sectors in the S&P 500, and it is all green today. And in fact, if you look at it on a 24-sector basis, we can get much more detailed. There are two groups that finish in the red. Consumer durables and apparel down 2.7%. That's because of Lululemon. And chip equipment companies unchanged on the day, but just moving into the red. But again, you have to dig pretty deep to find those red slices. For the most part, lots of green on the screen.
Well, and to that point, idiosyncratically, they were even bigger gainers and bigger decliners, but overall, that index holding steady. Jess, what do you got?
There is. So looking at Tesla, TSLA, the ticker symbol on this, up almost 4% at the close through here, after, of course, plunging 14% just yesterday. That actually had wiped out about $153 billion from the EV maker's market value just yesterday alone on that. But, of course, Elon Musk suggesting he was opening to making some amends here with President Trump, maybe staying off Twitter for a little bit here, or X rather, in the midst of this. So you did see a rebound a little bit here with that stock, but nonetheless was still a big plunge yesterday. And then, of course, looking at the IPO space with Omada Health, the ticker symbol is OMDA. That stock actually listed on the NASDAQ today. So this is actually, it provides a virtual chronic care to this, and that's important just given what the outlook is for the IPO space listed on the NASDAQ.
This has been a pretty strong week for, really the last 3 weeks have been pretty strong for new issuance.
It has, and then also we have another one coming up with Chime next week too. So that's going to be important. And it's actually, if you're thinking about, because Circle yesterday also had gone public as well, and so when you're thinking about also the space and the ECM market as well as far as companies more going public. You're seeing more optimism after a couple bumpy stretch there earlier this year as well.
And Circle rallying 29% today on the back of that 168+% gain yesterday.
So it's so interesting that 90-day reprieve that the president announced gave everyone room to breathe. It also gave these companies room to go public as well, because a lot of the IPOs were put on hold because of uncertain market conditions. They didn't want to launch at a time when nobody wanted to be anywhere close to going long on equities. But 90 days of pretty calm and quiet means that everyone can go forward with fundraising.
And it's not just new issuance; it's also M&A. I think you had something else on your board there that was kind of interesting at the bottom of the screen.
Actually, Quantex's building products.
Yeah.
The ticker symbol is NX. Now, I pointed out its market cap's less than $1 billion, but it's important because you're looking at the small cap space. It's actually up 11% today. It was its best day since April 9th. So it reported EPS and sales above those estimates. Of course, its stock unfortunately had lost about a third of its value over the last 12 months, but I had a feeling that Romaine was probably going to ask me what the best gainers were so far this week on semiconductor. It was actually, it's a chip supplier, so it was up about 20% this week, and then Dollar General right behind it, up 17% for the best gainers.
What about the decliners?
Of course, I knew you were going to say it. Lululemon, probably not surprisingly. We were talking about this after the bell yesterday.
I'm astonished by this drop.
Well,
are you not?
Well, also,
they didn't prep the investors. I mean, there was no expectation re-rate into it, right?
I feel like those telltale signs about the athleisure wear, especially if you're thinking about yoga pants or whatever people want to wear that are a bit more expensive typically than if you're buying at, say, more cheaper. But actually, that stock down almost 20% today. It's its worst day since March of 2020. So that actually brought its year-to-date losses to more than 30%. And so it's slowing growth outlook. That's interesting when you're thinking about something that's a little bit more expensive in that type of, and what it means potentially for the economy, but we'll have to see that.
But there's also a lot of competition because everyone's still wearing yoga pants, but you see Aloe and Viore and all these new brands coming out. So it's a lot of competition. I saw you had Petco on there.
Yes.
I'm a little confused by this. As somebody who basically is going broke because of his dog, I am curious to what's the problem there? They can't make money off pet owners?
Well, apparently its stock closed below $3 for the first time since the end of April. But this is also a company that's gone public at least 3 times in the last 30 years. So 1994, the early 2000s, and then again in 2021. So it's still off about 90% from that all-time high. And so comparable sales for the first quarter missed estimates, but it's supposed to be one of those transition type periods so far this year. So that's where the sell side is coming in. Actually, Jefferies has a hold price target. It's actually at $4, but still, I mean, when you're thinking about where the stock is trading,
but you're not cutting back. You got a dog, Scarlett.
I have a dog, but you know how I cut back? I buy all of her things at TJ Maxx and Marshall's because I don't need to pay full price at Petco.
Speaking my language.
Exactly. That's where I go to buy those. I mean, I don't do yoga, but if I feel like being lazy and just wearing those,
you're not going to go to Lululemon. You'll go to TJ Maxx.
Exactly. I'd rather just buy it there. Or even Walmart. They carry a lot of those.
No, TJ's all the way.
So I mean, the fact that Petco has been really pushing its wellness and its Vetco services, that makes a lot of sense because going to Vetco is going to be cheaper than paying for a private vet. But in terms of doggy bags or any their beds, I'm going to go to TJ Maxx for that.
Okay.
Boom. Yeah. All right. I don't have a dog, so I can't relate.
You have a cat, so you know.
It is. We do like local stores. It's the whole thing. Okay. Wrapping up with DocuSign. So this was the pandemic darling.
Does he like these artisanal cat stores in Brooklyn or something?
Yeah, kind of. Yeah. I don't do that. My husband.
Handcrafted treats.
So e-signature software company for DocuSign down about 19%. Its worst day since March of 2023 here. So that's actually had to do with billings, whether it was for the second quarter forecast as well as its 2026 yearly forecast. Those are what reined in here. So that was pressuring shares as well. So cutting that full year's billings forecast.
All right, I'm going to go to yields, guys, for a second, because it was a pretty active day in the bond market, selling across the curve, but really pronounced in that front end. If you look at, say, 2-year yield, yields popped the most since or beginning of May at one point. We're at the highest level now since mid-May. In terms of the 10-year, fell the most. They went up the most. Prices down, yields up, guys, just putting it out there. The 10-year, the most since Monday, April 7th.
Ooh.
April 7th, guys. Remember what happened on that Wednesday?
I'm still focused on what happened yesterday. Scarlett, where were you yesterday?
I was at the airport, and I was watching this, and it was kind of unreal because we all knew that some kind of break was inevitable, but the fact that it unfolded the way it did was really remarkable.
It really was.
It was good theater, if nothing else.
I think the theater is still going on, right?
Is it? I mean, it's calmed down a a little bit.
It's calmed down a little bit, but I mean, how long is that going to last?
Yeah, that's a good point. I mean,
I don't know. I mean, it seems like the staffers really want them to get together to just like cool it out and chill it out.
The two of them have not met up, and they
no.
haven't held a phone call. So
a phone call. So is this like Xi and Trump all over again or something? We're just going to sit by the phone and wait for them. Why do we need them to make a phone call?
Well, we want to hear that things are calm so that we can just kind of move on.
I think, yeah. I mean, look what happened yesterday. I did think that it's like, who has the control in this situation, in this relationship, right?
Trump does.
The president of the United States.
Yes.
But hold on a second, though, because Elon Musk has control over SpaceX, right? And SpaceX is really important to the U.S. government. So there is some kind of leverage on that point, right? I mean, they're the ones that transport astronauts and stuff to the space station.
You're not wrong, but also the president of the United States has a military, a Justice Department, and a lot of other levers.
And Congress at this point.
And Congress and a lot of other levers that he can pull. So if I was a betting person, which I'm not.
Okay.
Yeah.
Right.
There you go. Jess, do you have an opinion on this?
Well, isn't that robo-taxi event coming up next week?
I feel like there's always a robo-taxi event.
Right, I know. It's
there is a big robo. Thanks for bringing it back to the fundamentals here. But yeah, he is supposed to unveil these robo-taxis. But actually, I'm glad you pointed out because we had a big conversation yesterday with Ross Gerber about this idea of corporate governance and sort of what's going on with the board. We're going to have another conversation after the break as well. And it gets to this idea of what is the leadership of this company right now when he has spent the last few months in Washington. Now he's in this tit for tat. There are a lot of investors that want to see him at the helm of the company, but devoted to actually trying to do something with this company.
Just a week ago when I was on filling in for Tim Stenovic with Carol Massar last Friday with y'all, and Trump had mentioned that basically potentially Elon Musk could be back and forth in that role. Seems like that's potentially not going to happen now, but Elon had wanted to transition the company to more of an AI type company beyond just EV, but what does that mean moving forward from here?
All right, well, maybe we'll find out next week. Thanks for flagging that, Jess. Of course, Elon Musk is scheduled to have that robo-taxi event, a lot of other catalysts next week as well as we wrap up our coverage here of the closing bells. Our thanks to Jess Menton, who helps to lead our equities coverage here at Bloomberg. Alex Steele is off for the weekend. Hop along, my friend. Scarlet Fu, she's sticking around here, and a big discussion coming up after the break. Right here on Bloomberg Television, where we discuss the semiconductor landscape with Stacy Rasgon, senior analyst over at Bernstein Research. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Close. I'm Scarlett Fu.
And I'm Romaine Bostic. After flirting with the 20% rebound earlier in the week, the S&P 500 did it, closing up 20% from its April 8th low. It really is a remarkable 8-week turnaround from what was, of course, that stunning 2-week 14% sell-off that we saw in late March and in early April. And a big question right now about how much further this rally can go. The S&P 500 holding at 6,000. Remember, the all-time high, 6144 and change, so it still needs to rally roughly about another 2% to get there, though, but it is getting help from big tech. The Philadelphia Semiconductor Index up fractionally on the day, but big gains on the week of more than 3%. And there is yields, and this is something to keep an eye on because, of course, that inverse correlation becoming much more pronounced and something that is going to be a big factor as we go forward and whether that equity rally can continue. Scarlett, the 10-year yield, at least on the day, you see that moving higher by 11 basis points.
All right, let's take a look at some individual movers. Robinhood capping off a 6th straight day of gains, closing at a record high. Some speculation that the brokerage will soon be added to the S&P 500, which would mean passive funds would be forced to buy shares. We're awaiting an announcement from the index compiler after the close today. Tesla clawing back some of its losses after plunging 14% yesterday. Elon Musk signaling that he is open to making amends with the president after feuding with him yesterday. Lululemon plunging the most since March of 2020, losing 20% of its value after reporting a second straight disappointing quarter. At blame rising competition, new tariffs, a shift away from yoga pants. Its forecast for this quarter also trails estimates. And Broadcom, the chip supplier falling the most in almost 2 months. It gave a forecast for this quarter that only narrowly beat the average analyst estimate rather than meeting the highest estimate. So remain, I think, some concerns that expectations for the AI-fueled growth were likely too aggressive.
Well, let's go back to Tesla. There you see a 4% gain on the day. This after yesterday dropping 14%. In fact, yesterday it was its worst intraday drop going back to 2020. All eyes right now on the spat between Elon Musk and the president. But of course, investors also have their eyes on management of this company. We're now learning there has been a change in one of the key positions at that company. Ed Ludlow joins us right now. Ed, what do we know?
Yeah, so in the last few hours, Milan Kovac, who leads the Optimus Group, has informed staff at Tesla that today is his last day. He's essentially resigned and will leave the company and hand responsibility of the Tesla Optimus program over to someone called Ashok Ellaswamy. Ashok Ellaswamy is the executive at Tesla who is responsible for the autopilot team, the team that works on all of the software iterations for robotaxi, for FSD in consumer cars, and a bridge between the two of them. In the memo that Milan sent to other Tesla employees, he did not explain why he was leaving, but he did say that this was an absolute hard decision. Mm-hmm. And as you both know very well, Optimus is at the center of what Elon Musk sees as Tesla's long-term future, right? Yeah. $1 trillion addressable market and, hundreds of thousands of robots, both in the industrial and at-home use case. And there's skepticism around that. But this departure, the timing of it is interesting, but he is a senior leader at that company.
Ed Ludlow, co-host of Bloomberg Technology. We're keeping an eye on Tesla, and we're going to talk about that a little bit later in the show. But we do want to talk about the phenomenal rally in chip stocks on the week, a big rally in the Philadelphia Semiconductor Index on the back of some mixed earnings, including out of Broadcom earlier in the week. But so far, we're talking about an index that has recouped all of its year-to-date losses since hitting its low back on April 8th. The rally spurred by the number of tailwinds, including some clarity on the tariff situation. And, of course, a lot of folks doubling down on that AI trade. Stacy Rasgon joins us right now, senior analyst of U.S. Semiconductors over at Bernstein Research. And, Stacy, I know a lot of people were talking about, how much life was left in the AI trade. I think we got a real taste that, of course, not only is there life left in it, but there are years potentially left in it. It's just an evolving trade. And I'm curious as to where you see the evolution going right now.
Yeah, clearly there has been concerns, peak CapEx and then all the tariff stuff and everything. And frankly, just, it's been the case over the last few years. It's just the numbers have gotten so big so quickly. You just say, well, how long can it last? And as it turns out, it looks like it can still last longer than everybody thought. The only thing we've seen this year is numbers pretty much go up. CapEx budgets, people were worried that it would be at a peak this year. CapEx budgets this year going up. And now, given some of the reports we've seen from the companies and reports from the spenders and then all the sovereign and everything coming out of the Middle East, I think people are getting a little more comfortable that 2026 can be a good growth year as well. And so, I'd say the AI trade is back on spades.
When we talk about the individual players in this space, and let's just stick with the chip side of it obviously it's NVIDIA's world and we're all just living in it. But it's kind of interesting to see when Broadcom came out, and there was some talk, I know, heading into this earnings report that the new chips and the sort of accelerator nature of it might actually be able to sort of give it a better presence in the AI space. Obviously, investors were a little disappointed in some of the guidance, but I am curious, when you look at what they're trying to do, what some of the other companies in this space are also trying to do with regards to chips and chipsets, do you have any sort of confidence that anytime soon we will see a formidable competitor to NVIDIA, particularly to Blackwell?
Yeah, no, you bet. And so I would say Broadcom, by the way, the AI numbers were really good. The overall numbers were kind of in line-ish. That's because their non-AI semis are weak. They're not the only ones in that bucket. But the AI numbers, the guidance for next quarter on AI was quite strong. They guided $5.1 billion. And their commentary in 26 suggested 26 is going to grow a lot. If you sort of read between the lines, they seem to be suggesting AI revenues next year in the ballpark of $30 billion, which was, $5 billion above consensus. So no, the AI numbers for Broadcom were fine. I think the issue with Broadcom stock today was just that the stock went vertical, into the print. It was $200 a month ago. I think if it had been $200 going into this print, it would have been just fine. It would have been okay. As it was, expectations were high. It was kind of crowded into it, so it takes a little bit of a breather. But I don't think people were disappointed in AI for them at all.
Okay, so the bar was high.
In terms of a competitor to NVIDIA, it probably is Broadcom, frankly. The way the market seems to be setting up mostly is NVIDIA. And then for certain hyperscalers for internal workloads, they're all working on ASICs, but Broadcom seems to be the 800-pound gorilla there. Even there, though, I still feel like it's the wrong question which one's winning or losing. The question is the opportunity in front of us still big or is it not? If the opportunity is still big, I think they can both thrive. If it's not, they're both screwed. But I don't think that's the world that we're living in right now. I think that there's plenty of room for both of them to run for now.
Stacey, I didn't hear you mention AMD. Where does AMD fit into all of this? Because for a while it was seen as, the next winner. It would be able to pick up some of the slack if NVIDIA couldn't fulfill all the demand.
They're picking up some. I mean, they did $5 billion in AI sales last year, and I mean, look, it was zero the year before that. So I mean, I don't want to knock them, but I mean, in the grand scheme of things, it's just not that big. Like Nvidia did over $100 billion, and they're going to do a lot more this year. Whereas AMD, I think current consensus is probably 7, and that's been impacted in some sense by some of the China bans, but it's not that much. Like frankly, if I'm looking at the market as Nvidia and Broadcom and other ASIC players and AMD's probably losing share rather than growing it this year. So, like they're doing their best. It's just they have hardware that's behind what Nvidia is delivering, and they don't have the software, they don't have the ecosystem, they don't have the rack scale. They're trying to their credit, they're trying to build all of that. They're trying to acquire or build that capability.
Right.
And we'll see what they can do with it. But I mean, NVIDIA's already there. And remember, NVIDIA's not standing still. And Broadcom, they're not standing still. Right? That's the issue. It's a moving target.
It's a moving target. And I know you mentioned China, so I'm curious to get your take because Chinese and U.S. officials are scheduled to meet on Monday to discuss trade in London. Do you anticipate the presence of Howard Lutnick at these discussions will mean that controls on chip exports and chip designs will be on the negotiating table at that Monday meeting?
I don't know what Lutnick being there or not has to do with anything, frankly. I would assume that everything's on the table. Again, I don't know what they're going to be discussing, but I think trade and tariffs and export controls and bans, I mean, it all kind of hangs together. The strategic goals they're trying to drive, these are components of all of that, I think. So I presume it would all be on the table.
When you go back, though, Stacy, to the earnings call, and you heard what with NVIDIA, and you heard what Jensen Huang had to say, particularly about the Chinese market, kind of basically saying it isn't a market right now if these controls stay in place. It gets to this idea as to whether you can still see a growth story without the world's second largest economy.
Well, look, I think Jensen's absolutely right. And I'll be honest, I think it was idiotic of the government to ban what NVIDIA was selling. They were selling a product called the H20, which was already like Huawei and the Chinese companies already have products that from a raw compute standpoint are better than the H20. I have a 4090 gaming card upstairs that has more compute power than the H20 does, right? And so by banning that product, you're just handing the market over to Huawei. Like, why are we doing that? And you're encouraging the Chinese to build an ecosystem around the Huawei and the other chips that they can get. So to me, it seems really dumb to ban that product. Now, NVIDIA, to their credit, they're still growing a ton even without it. Like, they would have absolutely blown it away without the ban. And they are, again, working to develop products that will be legal to sell. And they've completely taken China out of their numbers. So to the extent that they can sell anything in China, at least it would be upside from here. And they're doing okay, but they're doing fine without it. But Jensen's right. Like, China's a big market. And if you can't compete there, you lose a lot of it. And then you're also encouraging the growth of alternative ecosystems, which long-term is not a good thing. So I'm fully with Jensen on this one.
All right, Stacy Rasgon, always appreciate your candor here. Stacy Rasgon is Senior Analyst of U.S. Semiconductors and Semiconductor Capital Equipment Research at Bernstein. Let's switch gears and talk about housing because the housing affordability crisis has reached a point where most young people can only buy homes with help from mom and dad. You look at Manhattan real estate, it has seen a 28% rise in home sales involving trusts in 2024. And now some wealthy TikTokers are embracing their status as so-called Nepo babies in what's become a viral trend. Let's bring in one of New York City's top brokers, Frances Katzen, founder of the Katzen team at Douglas Elliman. She's here now live in studio. Thanks for joining us today.
Thank you so much for having me.
Can you give us a sense, what are the numbers that back up this idea that first-time home buyers are leaning on their parents' bank account to be able to make their purchases?
I think we're seeing that it's so far out of reach in terms of the age that's now entering. It's like the average age now is 38 versus 22 many 3 decades ago. And I think what we're finding is that the high-cost cities make it very difficult to make it work with just one income. So having that generational wealth to back it makes a huge difference. It allows you to enter fast, compete, go higher on the offer. It's a very different game when you have it.
Are we talking about apartments? You mentioned cities, starter homes, or the homes that families grow into as their family gets bigger to accommodate the growing family that they're hoping to raise?
I think the entry market is the most impacted, and I think those are the ones that are becoming the Nepo babies in general. I think not having that is a very big challenge in high-cost cities.
How many of your transactions specifically are you seeing? And I know you kind of deal with maybe a little bit of a higher end consumer.
I do it all.
Yeah, okay.
I would say about 60% over the past 2 years have been parents buying or with children.
I am curious, though. I mean, I feel like over the years, and I'm talking over decades, there's always been some element of that, particularly for first-time home buyers. We've seen this a lot. If you have even not just at the high-income level, even if you're middle class, there's always that, maybe your parents help you out with the closing costs or something like that, or if you're wealthier, maybe they just, give you the whole shebang. Is it really a trend now where we are going to see a much higher concentration of home sales that are being facilitated by the parents of those folks buying them?
Absolutely.
Yeah.
I think it's because of the cost of living.
Yeah.
I think that when you have tariff discussions and rate increases, it curbs the capacity to get in at a price point that is mainstream market.
But what does that mean then for the real estate market? Because I mean, there's only so much of that to go around, right? I mean, when we talk about the parents who have the means to do that, I don't know what the exact national numbers would be, but I would assume it's a small percentage.
Well, I guess the question is, high-cost markets require more support. That's why you're finding people who are priced out land up going to better quality of life cities.
Gotcha.
So here's a question. When parents are helping their kids buy these homes, are the parents' names on the property as well, or is it all in the kids' names, or is it through trusts entirely?
So there's a big trend. I mean, 40% of the deals we're doing right now are either LLC or trust. And I think it's more than just parents buying for children. It's also setting out the foundation for generational wealth.
Got it. Does this mean that these are all cash transactions, or are even these LLCs and trusts using 30-year mortgages?
They are probably not doing 30 all of the time. They're doing 10-year. But what you're finding is that if they can get the child or working professional that needs the help.
Working professional and child.
That's right, with luck. You can actually sign on to the mortgage, which means that they now start creating their own credit and setting their own impact in the world of ownership.
All right, Francis, really fascinating report. Always great insights out of you. Francis Katzen over at Douglas Elliman. And when we come back, we're going to refocus on tech and now actually talk about Tesla and Elon Musk and President Trump and the fallout impacting the shares. But we're actually going to do that with Brett Winton. He's over at Ark Invest, and he knows a lot about what's going on over there. He's the chief futurist, but that really belies his title. We're going to talk about the models, the internal models they have at Ark to determine whether Tesla is still a good buy. That's coming up next here on The Close on Bloomberg. From bromance to breakup and now maybe a truce, Elon Musk and Donald Trump, that alliance ended in a big public spat over the last few hours, but Musk, at least for right now, has backed down just a little bit, and you did see a bit of a rebound in Tesla's stock price after that phenomenal drop that we saw yesterday of 14%, a 4% rise here on this day, and big questions right now about whether that stock, given all the drama, is still a buy. Let's bring Brett Winton into the conversation. He's chief futurist over at Ark Invest. Of course, the main Ark Innovation ETF, one of its biggest holdings, is still Tesla, representing about 10% of the net fund. And I do want to talk about the investment process, or at least the research process, Brett. You guys over at Ark, you have this whole scoring system of how to evaluate companies from a bottom-up perspective, obviously looking at revenue and profitability. But you also take a closer look at the people, the management, the culture of the company, board governance, et cetera. When you take a look at a company like Tesla, how does it sort of stack up on that main point?
Oh, it's at the highest of the highest score. I mean, I think Elon Musk, across the course of his career, has demonstrated that he can navigate companies towards the medium and long-term achievement of their mission. And so for Tesla, the most important thing to the company is not whether or not he's having a tiff with President Trump, but whether or not their robo-taxi launch in June in Austin will scale to multiple cities by the end of the year and across the U.S. by the end of next year. And that's where most of the value in the company lies. So when we underwrite companies, we look at the 5-year underwrite, like what is this company going to be look like 5 years forward? And we think Tesla is, very roughly a 10x over 5 years based upon our research. And so the political drama is noisy, but it's not new.
Yeah.
And we manage companies based on the fundamentals, not on headlines. And that's why we actively manage, because we can manage around this volatility. Disruptive innovation is by its nature volatile. And so we, of course, pay attention to and think about how this impacts our assessment of the companies. But yeah.
Well, I am curious, though. I mean, I know, we kind of make fun of the whole soap opera of it, and I understand that is the noise, and you are right. That does not necessarily translate into fundamentals and the bottom line. But when you start to hear the president or other officials in the White House talking about canceling contracts that whether it's Tesla or some of Elon Musk's other properties may have had involvement with, getting rid of EV mandates and other things that have been supportive of this company and its bottom line, I'm wondering when at all if you get a little bit nervous.
Yeah, well, across all of our positions, we have a thesis risk score, and we do raise that on the basis of, political vulnerability or vulnerability to regulation. The way we underwrite the companies is we don't assume that government subsidies are going to persist, because if you have exponential growth, then those subsidies become exponentially more politically costly, and so often they get pulled out from under companies just when they're relying upon them most. I think level the playing field for Tesla or for SpaceX or for Neuralink, and you will still have the best company in the world. There's a reason that SpaceX has the billions of dollars in contracts that it has. It's because it's the only company that can effectively deliver the launch services that not just the government, but commercial entities need. And so, yes, we have exposure to SpaceX, we have exposure to Neuralink, we have exposure to Tesla, and we believe in the long-term vision that he's espousing for those companies.
You mentioned robotaxis and Tesla and how that's really the future for the company. The question is whether the fallout with President Trump complicates the regulatory environment for those autonomous vehicles and then potentially slows the path forward for Tesla's robotaxi network. I mean, that is something that may be a factor in 5 years' time.
Sure, it's a fair point, and I think a global or a national kind of federal regulation on robotaxi would help not just Tesla, it would help Waymo, it would help any company that's trying to deliver autonomous vehicle services to the public. And so if that doesn't happen as a result of this, well, that'll hurt the American people, and it will pose the same headwind on Tesla that it does on Waymo and anybody else that tries to enter the market. So it does impact the adoption curve of robotaxi is really important to our underwriting of the company. And so if we had to reduce that adoption curve over time, then that would impact our 5-year point of view. Now, in our work, we actually thought there was only a 60% chance that they would launch robotaxi in this year. We thought it was a 40% chance next year. It's pretty clear it's going to happen this month. And so far, they've actually been surprising, at least in the near term, in terms of their ability to execute. And we'll see. Yeah,
I am curious, though, Brett, also just about the evolution of Tesla. There was a headline, a story on the Bloomberg terminal just a few minutes ago about the head of the Optimus, a humanoid robot program, exiting the company. And I am curious as to, again, this goes back to the idea of leadership and more importantly, management is probably a better phrase to use it. But do you worry at all that maybe you would have to adjust your bottom line estimates for the next few years if there is a material impact on that Optimus program?
Well, right now, we don't underwrite the Optimus program directly into our 5-year model. And in fact, humanoid robots is the technology area that has been really, we think, accelerated the most in terms of potential market impact by the acceleration in AI. As we're doing the work on humanoid robots and thinking about how that impacts Tesla, we'll, of course, take into account the current kind of velocity of the program. And just because somebody leaves, like Elon Musk is not an easy person to work for. I think we can all say that with some assurance. And it's because he drives people hard. He is not satisfied by, we'll get this done 6 months from now. He wants it done within the next 24 hours. And that drives his team into a maniacal sense of urgency, which is what you need when you are trying to make a dent in the universe, when you're trying to really push something that's profoundly new into the economy. And so far, he's delivered.
So I hear what you're saying on that, and that's what the Elon supporters have made their case on. I'm curious because Ark Venture Fund also has a stake in Elon Musk's AI startup XAI, which represents about 2% of the fund's holdings. There's going to be a $5 billion debt offering coming in in the next few weeks, not to mention a funding round as well. Do you think demand for those offerings will be dented, affected in any way by this dust-up between President Trump and Elon Musk?
No. I mean, I think people who are trying AI tools are using them because they get profound productivity advances out of them. And by the way, this is true for car purchasers as well as people who are trying to loft satellites into space, as well as the patients who weren't previously able to talk and get Neuralink, put into their, attached so that they can communicate with the world.
Right. No, but this isn't users. This is investors, people who would be buying the debt offering.
Oh, you're worried that investors are not going to buy the debt offering because they think that Elon said a mean thing to President Trump.
No, because the relationship broke up.
Well, I mean, I think every relationship is transactional in some way. And I think that both Trump and Elon probably have, slightly misaligned incentives, but both have kind of a strategic vision for what they're doing. But no, I'm not doubtful that XAI will be able to raise capital on the basis of this dust-up.
Brett? We've got to leave it there. Really appreciate you taking time for us and really appreciate you being candid here in your view. Chief Futurist over at Ark Invest. A closer look, Scarlett, at Tesla, one of the biggest gainers on the day, up about 4%, but of course, not enough to recoup that 14% drop from yesterday.
Absolutely. And if you look at what happened in the broader markets overall, Tesla's gain helped lift the S&P 500, closing above 6,000 once again. That was a 1% gain. The Mag 7 got a lift up by more than 2%. We did see yields higher, especially at the short end after the jobs report reduce the likelihood the Fed will move quickly to cut rates.
All right, a big week next week, of course, with that CPI data. And when we come back after the break, we're going to stretch our legs. This is a close on Bloomberg.
Now for Next Up, where we highlight the entrepreneurs moving the needle in markets, technology, and VC. And today we're looking at Stretch Zone, which offers practitioner-assisted stretching that uses a patented strapping system to help clients get a full range of motion. Stretch Zone has helped pro athletes from the NFL, NBA, and MLB. Joining us now to discuss is Tony Zaccario. He is CEO of Stretch Zone. Tony, great to speak with you. I guess my first question to you is, how is this different and distinct from physical therapy? Is it meant to replace that?
Yeah, and thanks for having me. And I don't think it's a replacement of physical therapy. I think at the end of the day, what has always made Stretch Zone so unique and a big reason why we've had so much success, growing to 400 locations in the next few weeks, is because Stretch Zone itself is so synergistic with so many other health and wellness alternatives or even health and wellness platforms. So whether you work out at a gym, Pilates by yourself, or whether maybe you are attending physical therapy or chiropractic, at the end of the day, you still need a stretch. And for us, because of that patented strapping system and because of the Stretch Zone methodology, we're just able to do it in a more effective and efficient manner.
You have 125 locations, and when I look at your website, clearly it shows people of all ages in the literature. But I would imagine that the nation's aging demographics is certainly a tailwind. So can you talk a little bit about where you choose your locations? Do you situate them near senior communities, near hospitals, for instance?
Yeah, no, really, 125 locations, that might be a little bit dated. We've actually opened up a little over 300 in the past 4 years. So I know it's been rapid and it's hard to keep track of it ourselves, but today in the next few weeks, we're opening up store number 400 across the country. Gotten here without a single store failure. And I think to your point, your question about, where do you position locations? I think what's really unique about Stretch Zone is, again, everyone understands that they need to stretch. A lot of people simply don't know how. Which is why it's very helpful to have a practitioner that has the knowledge base that ours do to do it for you. And so for our members, they really come to a location where they lay down at a table where we do all the work and you do all the benefits. And so it's not necessarily needed just near a health system or in a demographic with disposable income. It's every community needs it, whether it's working class and obviously the elderly themselves. The impact of stretching goes a lot longer than you might think.
So just be clear, this is a franchise model, right? And so when we talk about signing up new folks, how do you ensure consistency in the product? Because I know that's always a big issue in franchising, particularly on the consumer goods side or in the restaurant side. That's always a big thing. I'm curious about how that works in something like stretching, which is just hyper-personal, It's not going to be the same for every single customer, but I'm sure you want to make sure that there is some consistency, that if I decide to go to a stretch zone in New York and then go to one, I don't know, on the West Coast, that I'm going to get a similar experience.
Yeah, and for Stretch Zone, it started with how we created the organization. And so when we first started, it started with our founder, Jordan Gold, who really focused on honing in the methodology itself over the span of 15 years. And so by the time we opened up our first location in 2015, we had standardization behind the protocols. Now, the trick is the way in which our protocols are designed is that we can cater a unique program to whatever your needs might be. And so when it comes down to ensuring consistency with the stretch itself, whether you're getting stretch in Anchorage, Alaska, where we have 2 locations, or Florida or New York, wherever it might be, you're going to get the same quality of service. The challenge with franchising as a whole is always ensuring that beyond just the product that you're offering as a service, that the experience is top notch. And so our job as a franchisor is making sure we're picking the right franchisees that share core values and are dedicated to their communities.
But they also have to pick the right employees because, as you know, I mean, this is, again, the individual aspect of this, and there's got to be a lot of variances in there. So I am curious as to how much support you give those franchisees in trying to find the right therapist, for lack of a better word.
Well, first and foremost, you touched on the initial part. We have the patent and tracking system and the methodology. On top of that, we're the only nationally accredited stretch program. So we are the certifying body for all the practitioners that come inside the studio. So we at the franchisor level are able to ensure the quality and ensure the standardization of the stretch that's being delivered in any location across the country. But that's the primary way in which we can ensure consistency.
All right, Tony, really appreciate it. Tony Zaccario, he is Stretch Zone CEO, and of course a company that's gone a long way over the last 20 years since it was first founded here. And we are focusing in on entrepreneurship here. There is a big startup accelerator here in New York State called 43 North, and every year they have a big competition to decide who is next up, who is going to be the next big entrepreneur, a Shark Tank style competition where everyone gets a chance to sort of pitch their idea, and the winner gets a $1 million prize as well as support from 43 North. I'm pleased to say that Nicole Camarre, the Vice President of Investments at 43 North, joins us right now. And applications for the next big competition, which takes place this fall in October, that opens up next week. Nicole, how you doing?
Doing really well. Thank you so much for having me.
What's it like in terms of the types of competitors that you're going to get this year? I mean, it's always been kind of a wide range. You get people in the fintech space, you get people in healthcare, you get people in food products. What are you expecting this year?
Yeah, I think this year is going to be really interesting. We're at a really interesting time in the venture space. And so I think we're going to be seeing quite frankly, I think we're going to be seeing a lot more talent than we maybe even have in the past, and it's always been fantastic. But I'm almost expecting this year to see maybe some companies that are even a little bit further along than we have in the past, because maybe they're not necessarily seeing the liquidity in the venture markets that they have in the past. So quite honestly, I'm not necessarily sure that we have a specific sector that'll be different, but more maybe in the stage of the company we're seeing.
I am curious that you mentioned the stage, because we've talked with a lot of folks in the VC industry about current market conditions, the issues with the economy, obviously all of the chaos around tariffs and different trade restrictions. And the word that a lot of them have talked about is the idea of looking more towards mid and late stage companies rather than seed stage. And I am curious as to whether maybe that means that we will see less business creation, because if there isn't that seed funding, or you don't have VCs that are willing to do it at that early stage, that means you have to go for the companies that have a proven track record.
I mean, certainly, but I think if you talk to most investors, they'll also tell you that good deals still get done. So we're an innovation economy. We still very much want that. I do think that there is going to be potentially a dearth of venture capital at the earlier stages. And quite frankly, I think that's a massive opportunity for our program and for the community of Buffalo. So we are based in Buffalo, New York. Quite frankly, it's becoming harder and harder and more costly to be in some of the coastal markets. Certainly, that's where a lot of the venture dollars are. But especially with the pandemic, we've proven that you can work from secondary and tertiary markets. We're not far from Buffalo, from Boston, from New York, from Toronto, Chicago. You can easily hop on a plane, but you can grow companies in a much more capital efficient way in Buffalo, New York. And so for us, I think that's a massive opportunity.
It certainly is a massive opportunity. And you mentioned Toronto, and I know that Buffalo's economy is pretty intertwined with Toronto's economy. Does the U.S.-Canadian tensions over tariffs and the tension between the leaders of the country play a role here into how willing people are to pick up and move to Buffalo?
I mean, we'll certainly be very curious to see what kind of impacts there are on the applicants this year. quite frankly, I'm really hopeful that our Canadian partners across the border, are really interested in coming into the U.S. space still and see an opportunity there. And quite honestly, a lot of them will still probably want to make sure they have access to venture dollars in the U.S. And so I think we will see many companies coming over from Canada, but again, to be determined.
Okay, so we'll see how that all shakes out. In the meantime, you do bring some of your success stories back to the competition. Can you tell us one of them and how they play a role in upcoming competitions?
Yeah, thank you so much for asking that. We've actually seen numerous exits so far, and that's what we're looking for. We're looking for meaningful exits, as well as job creation. But we've had several companies go through the program that have been acquired, and we've actually had one IPO that was a company called ACB Auctions, and that is a B2B wholesale marketplace for used vehicles. That company is still here in Buffalo, as well as they've grown across the nation. But what's so great about them is the founders are still very active in our program and in the community. They still partner with some of our founders. In addition to that, we see them having some of those early employees that joined that company and got to really demonstrate what it's like to go from seed to exit. Those founders have now gone, those companies that they have founded now have actually applied to our program, and they have a couple of winners that have come out of that, one of which actually just exited a few weeks ago. So we're seeing the flywheel effect that you've seen in other markets like Boulder, like Austin. We're seeing that starting here, and we're really excited about that. And hopefully we can continue to see that flywheel take effect.
Do you think we're going to see more of that? I mean, we talk about Buffalo, and obviously this is a program, at least with its inception, was about sort of boosting the Buffalo economy, the greater Buffalo economy. I remember when these folks win this competition, they're supposed to set up shop there if they're not already based there. And I am curious about how successful that has been with regards to the economic impact and whether we are indeed in a phase right now where the dominance of the coast, New York, San Francisco, et cetera, for VC funding, that might have really finally loosened up.
I mean, I would love to see that, think that Buffalo is going to be the next major tech hub and venture hub, right? But I think we need to play to our strengths. I see some of the companies that are coming out of our program. You mentioned that they need to be here for a year. One of the things that we benchmark our success on is, are we driving enough value that after that first year, they want to stay here? We've had numerous companies that have stayed here. One recently, they were in our year 8 cohort. They're actually still here right now. They have a house where they're building, they're testing their technologies, and they're going out to fundraise. We're seeing that value being driven by their choice to stay here after the program, and that's because we're driving meaningful connections to some early clients. We're seeing some of the strategic advisors that we're bringing in, not just from the local community, but from the network we've built over the last 10 years that we've been investing in. Yeah. And we've also been making meaningful introductions to VCs along the coast. So I think that you're going to see more places like outside of the traditional coastal markets starting to pick up some steam. Certainly we'll still be spending time in those places for venture dollars, but I think you can build great companies anywhere.
All right, well said. Of course, this is, I believe, the 11th year here. The 43 North has been doing this, and the applications for the competition opens up next week, June 11th. That runs through July 9th. And then, of course, a long process there with the finals taking place in October. Nicole, I hope to see you there. Nicole Camarre, the Vice President of Investments over at 43 North. All right, it's been an incredibly busy week, and next week could potentially bring more market-moving catalysts. We're going to fill you in on what those catalysts might be when we come back after the break. This is Bloomberg. All right, here's what could potentially move the markets when we come back next week. And it starts on Monday with Scott Bessent, Howard Lutnick, and the rest of the U.S. trade team in London for trade talks with China. Another neutral third-party ground for them to continue their trade talks. And, of course, the announcement from President Trump that this was going to take place on Monday helped lift the stock market during trading today. Apple going to be holding their worldwide developer conference on Monday as well. That could potentially maybe move the market, or maybe not. Yeah, maybe, depending on what they say about AI, right? Or maybe what they don't say about AI. Yeah. Tuesday, a lot going on, including Bloomberg Invest in Hong Kong. Also keeping an eye on GameStop earnings. But the big show next week, at least in terms terms of economic data comes on Wednesday.
Yeah, U.S. CPI, and of course, after the latest jobs report, really allayed concerns that the hard data was deteriorating. The expectations here is that inflation is fairly under control. Right now, the expectation is for year-over-year growth of 2.5% for the month of May.
And we're also going to hear that same day from Double Line's Jeff Gundlach. He's going to be speaking at the Bloomberg Global Credit Forum. I'm sure they'll ask him about some of those CPI numbers. PPI is on Thursday, and a big Treasury auction as well.
The 30-year bond auction. This is going to be huge because there's been a lot of concern about the U.S.'s growing deficit and debt burden. Will investors show up?
That could really move the market. So, too, could the UMich consumer sentiment numbers that come out on Friday. Scarlett and I will be here all week on the close to bring you all of the market-moving action. For all your political news, stick around. Balance of Power is up next.